I'm Phil Baker, President and CEO of Hecla Mining Company. I am also the current chair of the Silver Institute, and thanks for joining me for this first quarter 2024 webcast. Before I talk about Hecla, I want to talk about silver because its fundamentals are unlike any time in history. First, solar. New investment in renewable energy was about $675 billion. Of that, $393 billion, or almost 60%, was solar, a 12% increase over 2022 and a new record. And this investment should continue. Silver's photovoltaic or PV demand increased to 194 million ounces, almost 4 times more than what it was 10 years ago, and is now 16% of global silver demand. Silver in solar has a 17% annual growth rate over the past 5 years, and another 40 million ounces should go into solar in 2024. This 40 million ounce increase is about the same as the total solar demand was in 2013. And to meet it from mines, it's going to take 4 new Greens Creek mines or 8 new Lucky Friday mines. Now, India. India is a longtime consumer of silver, but in February, imports set a monthly record of 77 million ounces, with first quarter imports exceeding all that was imported in 2023. And despite very strong prices, this happened, and the price of silver in rupee terms had hit an all-time high in April. So you put solar and Indian demand together, and that's about 35% of silver's global demand, and they're both growing. And the 3-year deficit is now over 500 million ounces, with more deficits this year and into the foreseeable future. Don't be short silver. About Hecla. There are 3 key messages this quarter. First, our silver operations are strong and consistent, with Greens Creek delivering a solid quarter and Lucky Friday achieving full ramp-up. Second, Keno Hill's ramp-up is going well with incremental and steady improvements in the safety culture and in engineering risks out of the mine. And then third, the first quarter is an inflection point, with strong free cash flows from our established silver operations, improving performance of Keno, and the insurance proceeds that we'll receive over the remainder of the year, which we'll use to de-lever over the next 12 months. As our silver operations grow and gold declines, silver revenues are now 44% of the $190 million of revenues that we generated in the first quarter. Lucky Friday's costs were slightly higher with the ramp up, but margins were maintained. And we expect to see the net leverage ratio improve to less than 2 times over the next 12 months with revolver debt repayments. The only mine I'm going to focus on is our newest, Keno Hill, which is in the Yukon, and it's Canada's soon-to-be largest silver mine. Keno is improving as we consider everything through the lens of safety and environmental improvement. We are making it safer. The all-in frequency rate is down 41%, but that's still too high. Like every operation, there's a 2-prong approach to making mines safer. It's changing behavior, and it's engineering or designing out the risks. For behavior, we initiated a 10-step action plan to implement best behavioral practices. That program is now 40% complete. While significant potential incidents remain roughly where they were last year, reporting of the incidents have increased, and that's a good thing, because that's the key to a safe site. No fear in telling what is really happening. And the team is responding well to that. On the engineering and designing out the risk, we're focused on modifications to environmental controls to bring it to Hecla standards, which in some cases exceed the legal requirements. Operationally, the biggest risk reducer will be the cemented tails batch plant, allowing underhand mining at Birmingham. With changing ground conditions, nothing could make it safer and more productive than having miners mine under a constructed back. The plant will be completed by year-end with full conversion to underhand mining by the end of 2025. Now we're at 277 tons per day now, and all of that's coming from Birmingham, and that's about 30% more than last quarter. But there's still too much variability in each day's mine and mill performance. But it's getting better and a lot better, with even more consistency in April and May. Now we've learned, particularly in the shoulder seasons, to manage the clay from Birmingham, we need the hard rock from Flame & Moth deposit to make the crusher run better. So despite Flame & Moth being lower grade, we will mine it to make the crushing better, and you're going to start to see that in the next few months. Now, this quarter's 600,000 ounces has made us confident that we're going to hit our production numbers and reach commercial and full production probably before year end, but only if we make the mine safer and more environmentally compliant. Finally, the exploration shows why we are taking a long-term view. We had great results last quarter, and the follow-up drilling is as good with additional intercepts in the footwall vein, one of which is 55.4 ounces per ton over nearly 41 feet, and the second was 51.2 ounces over almost 40 feet. These holes are near existing infrastructure and more than 4 times wider than our average width. Thanks for watching. Please go to hecla.com to learn more about Hecla and the silverinstitute.org for more about silver.